Our next segment, we are really excited to have John Mackay with us from Schroders, terrific investment firm, longstanding history, and really one of our core partners in creating these portfolios. So let's get the experts in here and hopefully get some pretty good opinions about what we have to look forward to. John, are you with us?
I'm here. Good to be here. Thanks for having me.
John,
hey John,
welcome to the Lebenthal Report.
Great to be here.
Appreciate you taking the time. So happy to have you on board and really kind of looking forward to your opinions. We've had a pretty interesting year end and a new one starting. So why don't you kind of just jump in with your thoughts on the subject matter, and then we'd love to pick your brain.
Sure, I'd be happy to. So the way we're thinking about it is the old economic cycle ended on March 23rd, 2020, and the new economic cycle started. And I'm picking that date because it was the bottom of the S&P 500's drawdown that was around 33%. The market started rallying from there. And really what we were looking forward to was a reopening of economies, not just in the US, but around the world, on the back of fiscal stimulus support, monetary support, as well as an eventual vaccine announcement, which we got in November of last year. And what we've seen happening underneath the surface of the market is essentially a rotation out of those stay-at-home trades, sort of consumer staples, big, large cap internet stocks, into cyclically oriented stocks. And what I mean by that is stocks that are very sensitive to the economic cycle. So if you think about the way the US market is made up, it's much more skewed to stay at home than it is to sort of the reopening trade or the cyclical trade. And so what we've seen happening around the world is economies, markets, sectors that are more exposed to a cyclical reopening are doing better than those that aren't. So the leaders have become the laggards have become the leaders. And so that's how we think things are going to play out over the next year or so.
John, we were talking early this morning in our Dom and I do a call every Tuesday morning with our advisors, and we were talking this morning how the goalposts for the reopening of the country and the world keep moving. Originally Dr. Fauci said we should all be back at ball games and concerts by July, and then I read a few weeks later, September. This morning, the WHO said all of 2021 will be what will it take to get to herd immunity. So at what point does the market get tired of waiting, or does the market retrace its gains because we keep having this reemergence push back?
So I don't think it's black and white like that, right? You're going to have certain countries around the world are going to be ahead of others. We've already seen this happening with Southeast Asia. And, the pushback I've gotten to saying, well, China's gotten the virus under control is you can't believe the numbers in China. But what you can do is you can look at travel data, you can look at energy usage, you can look at restaurant bookings. You can also do the same thing for a country like South Korea, which is much more open than China is, and the data is much more reliable. And so I think as we move through this year, you're going to see countries that are either more effective at distributing the vaccine. They've done a better job at curbing the rise in coronavirus cases and the capacity at hospital emergency rooms. We've seen that with a very strict lockdown in the UK right now. The virus numbers are currently very bad there, but they will get better as they go through that very strict lockdown. Countries like France and Germany are implementing more strict lockdowns on a national level. And I think you'll see exactly the same thing happening here in the US, where states like West Virginia are actually being fairly successful in distributing the vaccine. Other states, New York and California most notably, are struggling with it for various reasons. So I think it's very hard to say that by the end of 2021 is when things will be officially reopened. I think it's going to be a staged reopening by state, by county, by country around the world. And so I think what the market's pricing in is somewhere around the middle of the year, things are going to be better than they are today, which means economic activity will be better. And I think what the markets have been pricing in late last year was much better economic growth this year. That's what we expect at Schroders. We expect a very strong year from a global economic perspective. We think growth will be led by emerging markets. We think the US is going to grow by 4% plus this year, Europe by 5% plus this year. Part of that is calendar effect. Part of that is obviously just people being able to get out there and live their lives again. And that's what the market's priced in. But I think the difference is this year we're not going to have 50, 60, 70% plus returns in equity markets. They're going to be much more muted. And I think that's the point you were trying to make, which is that there will be bad news. There will be hiccups along the way. There will be stumbles along the way. And the markets will sell off a little bit on that. But I think the way we're thinking about it is use those moments as a chance to continue the rotation out of the winners that we've seen over the last couple of years into the winners going forward, which will be those cyclically oriented stocks.
So, John, I've looked at Europe, certainly this last year, is almost like a leading indicator of where we are in the status of the virus. And it seems like they were 4 to 6 weeks ahead of us. From the peaks to trough, now back to peak. So I'm looking at us over the next 4 to 6 weeks, and I see things getting substantially worse before they get better, but then hopefully they do get better. How do you think markets are going to react? Are they going to finally wake up to the short-term risks here, or they're just blinders on?
I think this is going to sound callous, but I think a little bit of blinders on. And a big piece of that is a combination of two things. One is we've seen this before, so it's not a surprise this time. We know the data is going to be bad. We've seen record-setting new virus cases here in the US. We've seen record-setting, unfortunately, mortality rates in the US. But we know that we know how to deal with it. We know how to live with it. We know how to treat it better than we did before. And we also have in our back pocket significant fiscal stimulus, obviously the $900 billion package that was passed over the Christmas break. Biden is talking about another package that we estimate will be somewhere between $900 billion to maybe $1 trillion. And you've also got the Fed, who's basically said they're not going to touch they're not going to pump the brakes whatsoever until we see average inflation move above 2%. We don't know how far above, and we don't know how long, but that is a lot of firepower. From a fiscal and a monetary perspective, coupled with the fact that we're, as I said before, used to this, coupled with the fact that household balance sheets are in pretty good shape. So we have the ability to withstand this resurgence in the virus. And you could say the same exact thing about Europe. You could say the same exact thing about a resurgence of the virus in other parts of the world as well. It's sort of once bitten, twice shy. We know how to deal with it. We've seen this before. It's not a surprise. I guess what would surprise us is a new strain of the virus that wasn't able to be treated by the vaccines that have been rolled out over the past couple of months. That's another positive, by the way, is we will get more vaccines on top of the 2 that have already been approved. We will have another 2 or 3 within the next 6 to 8 weeks that are approved, not just here in the US, but around the world. And those numbers can be added to the vaccination rollout that we've seen over the past sort of 4 to 6 weeks.
So let's focus. We finally reintroduced international exposure in our portfolios, I guess about 6 months ago, primarily on the weakness of the dollar. We thought that trend would continue, ultra low rates here in the US, finally compared to the rest of the world. So maybe a focus on international markets in general and emerging markets, if you'd love to jump in on that one.
Yeah, so I think there's 3 things to think about when you're thinking about international. One is you want valuations to be cheap. You need a good starting point. That's, cheap markets can stay cheap for a long period of time. We've seen that with Europe. We've seen that with emerging markets. They've been cheaper than the US for effectively the last decade, and they haven't done anything. You've had a year here or there that's been good, but effectively they've stayed cheap, and they've stayed cheap for a good reason. The good reason is lack of earnings growth. You need earnings growth to move those markets higher. What we've seen in estimates over the next year and 2 years is significantly stronger earnings growth out of Europe, Japan, and emerging markets versus the US in 2021 and 2022. We think that's going to be the driver to push prices back up to a level that's comparable to what we see here in the US. The third reason is the cyclical makeup of those markets. So more than 60% of the US equity market is what we describe as non-cyclical. It's communications, it is info tech, it is healthcare, and it is also consumer staples and utilities, which are effectively defensive stocks. If you look overseas at Europe, Japan, and emerging markets, it's more than 60% of those markets are cyclical. So if we get that cyclical, growth impulse, which we think we've seen already, those markets should do better as they're more skewed to that, they're more tied to that. The last piece of the puzzle is what you talked about earlier, Dom, which is the weakness in the dollar. If you look over long periods of time, and I'm talking about 40 to 50 years, when the dollar is going down, international does better than the US. When the dollar is going up, international does worse than the US. We've seen that over the last 10 years, the dollar strengthened, international has lagged. In the previous 10 years, the dollar weakened, international worked really well. And it almost goes up and down about every 10 years. I'm generalizing here, but that's a fair way to think about it. The 90s was the US, the 80s was international, the 70s was the US, and so on. The driver of the dollar tends to be a couple of things, but deficits matter. Twin deficits especially. We're going to have the worst twin deficits here in the US going back to the 1940s. So that's our current account deficit, as well as our fiscal deficit. Current account is how much we buy or sell from other countries, how much we're selling to them, how much they're buying from us. We tend to buy more than we sell overseas. That's our trade deficit. Fiscal deficit, not surprisingly, is worse because of all the fiscal stimulus that we've put into the economy to try and support the slowdown in growth. Ours is worse, by the way, than the rest of the world. Worse than Europe, worse than Japan, worse than most emerging market economies. The other piece of it you touched on, which is interest rate differentials and growth differentials. We're not going to grow as fast as the rest of the world, all else being equal, this year here in the US. So the growth advantage we enjoyed for much of the past decade is now gone. We should at best be equal to countries like Germany, France, and Italy. And obviously most of emerging markets is going to grow faster than us. That's been true quite some period of time. So we think the weakness we've seen in the dollar over the last year will continue. If you're investing overseas, you're investing in local shares, you're bringing those share returns back to the US. And if the dollar is weaker, you will get a boost to your returns. And so those are all the reasons: valuations, earnings growth, economic growth, cyclical skew in international, and obviously a weaker dollar will help international equities, we think, do better.
So, John, let me ask you this. 4 years ago, there was much ink spilled and a lot of anxiety about the Brexit. And here we are 4 years later, and it's official. And I know there's other fish to fry here in America, but could you talk a little bit about the Brexit as it relates to the UK and the rest of the EU? Can they both win? Are there going to be winners and losers? Is this something we should be worried about here in America?
No, it's, as you said, it's amazing to hear 4 years ago was the vote in the summer of 2016, and they finally finished the negotiating process and Brexit is done. They have put a set of rules in place for taxes on goods that are going into and out of the UK from Europe. And there are some rules in place that may make those taxes go up or down depending on things like workplace practices, environmental practices, regulations around worker compensation, basically fairness rules. If UK tries to take a particular industry and give them a competitive advantage, then taxes are going to go up in Europe, and vice versa. If Europe tries to do that to a particular industry and give themselves a particular advantage for goods going back into the UK, the UK can then tax those goods higher. So I would argue that it puts the UK at a slight disadvantage versus where they were before, where they just, it was free trade of goods. Now there are these additional rules and complications, which makes doing business more difficult. As we all know, the more complicated the rule books are, the more difficult it is to get business done. But all else being equal, we at least have a roadmap now through which we can figure out what trade will look like, what impact that might have to earnings, what impact that might have to economic growth in the UK. And so at least you have a roadmap to run your investments by, your roadmap to run your businesses by. And so I think we can, to a large degree, put the Brexit to rest now. We can hopefully get rid of that terrible term, which has been hanging over the markets, at least from a European perspective, for the last 4+ years.
John, I got one last question, if you don't mind. And unfortunately, it's probably a long answer, but I'll do the best you can.
Okay.
Really under the radar, this is not a political question, but China just signed an accord with the EU, and it looks like there's going to be a significant amount of euros coming into Europe and help them grow economically. I think that could be a further fuel in the fire economically for Europe. Any opinion on that?
Yeah, so I think a lot of it honestly ties back to Europe's efforts to grow their presence in emerging markets as a trading bloc. So Europe exports more to emerging markets than they do to the US or just about any other developed economy in the world. China is a huge piece of that. And I think the deal you're seeing is an effort by Europe to further gain access to a burgeoning middle class, specifically within China, which is roughly 400 million people. If you think about that compared to the size of the US, we've got 340, 350 million people. You've got a burgeoning millennial class, which likes luxury goods, a lot of which come out of the European Union. And so I think, if Europe signs this deal, and as you said, a lot of money from China going into the European Union, that's going to help their growth prospects going forward, coupled with fiscal stimulus. They signed an agreement last year. It's going to be the first time they're going to be able to issue debt for the specific purpose of fiscal stimulus as jointly issued debt. Think about treasuries we issue here in the US. The proceeds from that treasury issuance is then spread across the states on a pro rata basis, depending on who needs it more, who needs it less, et cetera. Sort of the Hamilton moment for Europe happened last year. So we're pretty bullish actually on the outlook for European growth, for a number of other reasons, but this China deal that you just mentioned is part of that reason that we think Europe can actually have better than expected growth than we've seen over the past 10 years.
And when
Fantastic.
you say Europe, do you still include the UK, or does now going forward, do you have to bifurcate UK out of that analysis?
It'd be Europe ex UK.
Okay. Thanks, John.
Sure.
Well, John, can't thank you enough. We probably could speak to you all day. Hopefully you'll give us the pleasure to join us in the future again. Can't thank you enough for the time you took with us today.
Thanks, guys. Happy to be here.
Thank you, John. Happy New Year.
Happy New Year.